we can plot what the optimal Kelly is with this F equals P minus Q over B formula, which is just percentage of wins and the relative size of wins to losses. And it moves around, but it's always above about 75%. So the assumption is that if you're rebalancing just once per year, you should have up to 3/4 of your portfolio allocated to Bitcoin.
So that's the optimal allocation that the Kelly Criterion suggests for Bitcoin. Amazing. Hi, everyone. Welcome to another episode. I'm inviting Steve Perrenod for the second time. We just had another episode about Michael Saylor's models and the power law model. Today, we're going to talk about something that's very useful and interesting for the average person. How can we use Bitcoin for personal planning, personal finance, and how we can use Bitcoin models to give us a better sense of how we should manage our own money? One of the models that give us a quantitative and reliable method to think about allocation is Kelly Criterion, which explains the amount of allocation that a person needs to an asset or to an opportunity or to some kind of gamble that optimizes their performance. So today we're going to learn about Kelly Criterion, how people can use it to make smarter decisions about their money, and what is the recommended allocation to Bitcoin that comes out of this model. So Steve, thanks a lot for coming on. I appreciate your time. And if you want to tell us a little bit about your work today and share your slides with us.
Okay, great. Thanks for having me on again. So my name is Stephen Perrenod. I'm a technology analyst and partner at orionx.net. We're a boutique consulting firm in Silicon Valley. I have the luxury of working remotely. My background's astrophysics originally, and then 3 decades in high performance computing and supercomputing industry. And so I have a technology bent that's also part of the reason why I'm interested in Bitcoin. And I've been involved in Bitcoin for about 10 years now. I would say I became a maximalist after the blockchain wars in 2017. And I started looking at the Kelly criteria 2 or 3 years ago. I read some of the textbook work on it. It is argued to be a method to maximize the growth of the logarithm of your wealth. So it's a portfolio optimization method that's designed to grow your wealth. And the argument is that you want to not worry about linear wealth, but you want to worry about log wealth. So that's the theoretical underpinning of it. So let me share the slides. Kelly Criterion for Bitcoin portfolio optimization. We want to maximize log wealth. And these are going to be pretty simple models because I'm not considering complex portfolios with a lot of assets. I'm thinking that Bitcoin is superior and that you have Bitcoin and then you have a lot of things that look more like fiat. And so we're going to basically be measuring Bitcoin against fiat, but you can do this against gold, and I'll do it against a couple of other assets as well. So that'll give you some feel for it. It gets pretty complex as you start constructing 3 and 4 and 5 and multi-asset portfolios with this. So what is the Kelly criterion? It comes from John L. Kelly, who worked at Bell Labs in 1956. And he worked together with Claude Shannon, who's very famous for his work on dealing with information and communication networks and signal to noise across telephone lines. And he's the one who defined the entropy of information. You can see the equation there. And Kelly took that work and then figured out how to apply it into finance and also into gambling. And so the point is that it optimizes log wealth, and you can prove that. And it takes into account compounding. It takes into account pullbacks in your wealth and losses, but it also avoids excessive streaks of losses by re-optimizing and rebalancing your allocation.
So quick question. Any particular reason he focuses on log wealth, not the linear wealth?
Yeah, I will sort of show that. But the idea is that by doing that, you protect yourself from ruin with a string of losses.
Yeah. So, okay, now I get it. Essentially,
Yes,
this log transforms huge gains to be more or less comparable to small losses. And losses tend to be more painful.
right.
So, this protects you a little bit more against losses than optimizing for gains.
That's correct. And the philosophical underpinning is a utility function, which is if I lose half my money, I feel about as bad as when I double my money, how good I feel when I double my money.
Yes, I
Because
think,
losing half
yeah.
my money has a big impact on my life circumstances.
Absolutely. And also psychologically, your brain feels it more strongly. I think it was Kahneman who first
Mhm.
discovered this in economics, and he won a Nobel
Right,
Prize for it. They called it prospect theory. And the idea
right.
was very simple that when you do a lot of experiments on people, you see that their brains hurts a lot more when they lose $1 versus when they gain $1. So then he'd realized that if you look at the curve of the value of gains versus losses, the loss curve is much steeper. So it quickly becomes very significant for people, but gains grow slower in terms of their value. This is a beautiful way to look at it.
Okay, excellent. So the original formula, and there are actually multiple formulas, there are three main ones. We'll cover two of them that are rather extreme and different in their results. But the original gambler's formula, the first one that John Kelly published, is that log wealth is maximized in a portfolio where you have two assets and you think of it as a series of bets, and you have a win rate P, and then you have a loss rate Q, and P plus Q is equal to 1. And then you have to measure how big is the average win and how big is the average loss. So if my wins are bigger, it's good, right? If I win twice as much when I have a positive outcome as when I lose, then that's good too. So you want higher P and you want higher B. So
So
for
let me add one thing.
yeah,
As early as 1956, scientists understood that you have to look at a series of investments, a series of actions, right? But these days, you hear from a lot of people that say, hey, I put money in Dogecoin and it gave me a huge return. But that's a one time thing. You have to think over the long run. Can you repeat this performance or not? If you have a strategy that gives you a huge gain in the beginning, but then you also running the risk of completely losing your money next time, over time, you're not going to make it. So this model thinks about a series of bets and looks at the average or the total performance.
good. That's key. Now, what else is important is your time window. How often do you make a bet? Or in this case, how often do you rebalance between Bitcoin and dollars or Bitcoin and gold, Bitcoin and some other asset? So what this does with this form, the gambler's formula, it allows for the possibility of total loss, and it is aggressive because it is optimal way to grow your wealth. The F that you end up calculating here at any given time, but it still limits your chance of ruin. So there's a small but limited chance of ruin. And the key is that you have to rebalance at each time window. So if you've had a series of losses, the F is going to go down, right? And so you're going to lower your asset allocation to this risky thing, which in our case is Bitcoin. Risky meaning the volatility is high. So here's the actual derivation. ChatGPT will give you the derivation of this. So this comes from them. But basically, if you look in this box with the white background, if you win, your wealth goes up by 1 plus B over F. That's the expected increase, where B is the average ratio of win to loss. And if you lose, your wealth drops. So you have this allocation F, which is a percentage or just a fractional number. And then you have this win-loss ratio. So you win 1 plus B over F, but you lose 1 minus F. And then you calculate the expected value, and then you maximize by taking the derivative, and you end up with this thing in number 4. And if you rearrange that, you end up with the equation I just showed you.
This doesn't talk about the rest of your portfolio, right? Just only talks about the allocation part to that bet, right?
I'm going to show you only two assets,
Mhm.
Bitcoin in dollars or Bitcoin in gold, right? We're going to keep it simple. If you want to have a multi-asset portfolio, then you have to construct a covariance matrix. It gets quite a bit more complex.
Got it.
There's a whole book, the Kelly Capital Growth and Investment Criteria, that has a bunch of key chapters in it that are written by Kelly and another guy, Thorpe, who did a lot of work here. And there are many people that have looked at it as to why maximizing log of wealth is the way to go. And you just discussed some of the philosophical underpinnings for that. But basically, it comes down to risk aversion, long-term growth, avoiding ruin, and
Makes a lot
balancing
of sense.
the relative utility of wins and losses. So the main formula, again, is P minus Q over B. In other words, if I win half the time, then P is 0.5 and Q is 0.5. But if my wins are twice as large, what's that formula going to be? It's going to say P minus, it's going to say 0.5 minus 0.5 over 2. And so I'm going to allocate 25% as the optimal fraction. You might think it's higher, right? I'm winning half the time, I'm winning twice as much. But Kelly would say, hold on, that's not optimal. You can also calculate the expected return, which is this formula on the second line. And it's the log of the two things. And one of these logs is 1 minus f. So it's the log of a number less than 1. So it's a negative number. So the first term is positive, the second term is negative. And so that's the expected return for the next time frame. Okay, so we have two charts. The first chart is calculating the optimal fraction with Gambler's Kelly that you want to commit to Bitcoin based just on annual prices and the end of year value. And for 2024, I used the current price, so it's not quite a full year, but that's okay. It's still been pretty positive. And so when you start out, you say, wow, 2011, 2012, it's going up really rapidly. I should be 100% in. And then you have your first losing year and it drops down to 75%. And then you have winning years. And as we know, 3 out of 4 years you win, right? So in the long run, P has been 75%. So actually, the ultimate fraction is 75% minus 25% divided by B, the win-loss ratio. And we see that this thing is bounced around, but basically is kind of 75% right now, if we use every annual result. So that's our annual window. We're not going to rebalance during the year. We're going to rebalance in January, one time per year. And it's going to be that fraction. So if it's 2016, if it's 2017, I say I'm 83% in Bitcoin. Now I would say I should be 77%. If my portfolio has $100,000, I should have 77,000 of Bitcoin. That's optimal. I should not have more, because then if there's a loss, I'm not in a good position to handle that loss, and I've increased my risk of ruin.
This is, I think, the key slide.
So in summary, and this is a quick introduction, and I'm going to show a lot more details of how things behave on different time frames. But if we start with the annual time frame, we have what, 14, 15 data points, right? And we can plot in this upper plot, we can plot what the optimal Gambler's Kelly is with this F equals P minus Q over B formula, which is just percentage of wins and the relative size of wins to losses. And it moves around, but it's always above about 75%. So the assumption is that if you're rebalancing just once per year, you should have up to 3/4 of your portfolio allocated to Bitcoin.
So that's the optimal allocation that the Kelly Criterion, the gambler's version, suggests for Bitcoin. Amazing.
Now, this is because the win-loss ratio has been so high. And so the lower plot plots the win-loss ratio, and it started out being around 40, right? And it's dropped now to it's in the ratio is about 12. So the wins are really big. Now, that's the historical average, right? Now, one might argue that we're not going to get such going forward, such really large wins. So one might choose to say, okay, I'll only do a 5-year look back because I just don't think those 800% returns are going to happen ever again, right? And the power law suggests that as well. If you do that, you still get high allocations because even with a win-loss ratio of 3 to 5, if you divide 25% by 5, that's 5%. And if you're winning 3 out of 4 years, you're still getting a 70% Kelly, or a Kelly that if it's only a B equals 3, you're still getting 67% Kelly. Even
That's not a huge difference.
Yeah, not a huge difference.
Even though you're missing out on a lot of the early on gains, still your best bet is to keep a similar amount moving forward.
As long as we're winning 3 out of 4 years, right? And as long as the wins are bigger. Now, the Kelly Criterion is very sensitive to your rebalancing time frame. So here I show shorter time periods. And on the left, the upper one is weekly. The lower one is monthly, it's 4 weekly. And then the one to the right is quarterly. And what you see is the Kelly fractions are much, much lower. For the weekly one, you shouldn't have more than about 20%. Now it's down to about 18%. Now it's extremely noisy. I'll show you later a very noisy weekly one for the continuous, but it's very noisy. So what you have to do is I've used a sliding window because if you go back for the whole history, you're probably not getting a good sample for something that's this short a time frame that's weekly. For the monthly one, which is on the left, the lower left, I also show the edge, which is this B ratio. And you can see it's not as high. It's in the 1.5 to 2 range. And the Kelly fraction is down around 29% right now. And the proportion of wins is not 75%, but it's somewhat above 50%. It's kind of 55-ish. And then if we go to the quarterly, the edge is bigger. So the bigger time window you take or your decision points are going to give you more success because you have a higher probability of winning and you also have a higher edge ratio. With quarterly decision points, the edge ratio is close to 3 currently. And so you would have a 40% allocation if you were rebalancing every quarter. And for these charts, I actually included 4% yield for cash as the alternative, but it doesn't make that much difference.
Yeah, good point.
The core message is the more chill you are, the more Bitcoin you should hold.
What if you never rebalance? Or maybe just
100%.
once at the end.
100%. Yeah. But it's not Kelly optimal because we have these losing years, right? And there is risk of ruin. Now, it turns out if you use a slightly modified version that's called the investment version, it rearranges the win and loss terms, and it does basically come out to 100%. I don't actually show that here. This shows equity curves for weekly, quarterly, and for yearly. And it starts in each case from 2018 with $1,000. And so if you use the Kelly Criterion rebalance weekly, you would grow to $1,800 by now. But if you were more patient and did it about once a month, you'd grow 50% more than that. And then if you used their quarterly criterion, you'd grow your wealth from 1,000 to 6,300 over 6 years. So that becomes interesting. And then if you just made annual decisions, you would grow from 1,000 to over 10,000. But you'd have some bump. You'd have some bumps, or one big bump along the way where you'd lose a third of your wealth.
The more stoic you approach Bitcoin, the better the performance.
Absolutely.
Have you
Bitcoin is
also
for
looked at, have
stoics.
you also tried to optimize the rebalancing period? Maybe what is it that gives you the best performance? Maybe it's 2 years. We already know that anything below 1 year is bad, but what about
Right.
larger?
I haven't checked 2 years. We don't have many data points. We only have 7 data points. So it's already getting a little sparse, right? To have a series that right now has just over a dozen data points. I did look once at, if you just say once every 4 years, but I've forgotten what the result was. It's quite high.
Mhm.
Actually, if you do once every 4 years, you have no losing years. So you end up with 100% allocation.
Got it.
So if you only reallocate at the halvings, you'll always be at 100%.
Mhm. That
But
makes
that's
sense.
that's 4 data points, right?
Very cool.
This is another look at with quarterly rebalancing. In this case, it's normalized. It actually starts 10 years ago, but it's normalized to 10,000 8 years ago. And it grew from under 10,000 to 300,000 by now. That's over a 10-year period. And you can see what happens, though. You end up having to sell to rebalance, right? So you started out with almost 10 Bitcoins and you end up with less than 2 by now. So you make money a lot in fiat terms, but you've lost most of your Bitcoin if you rebalance quarterly. And the Kelly fraction went from 0.6, it went up to 0.8, and then it dropped all the way down to about 0.3 by now with quarterly rebalancing. And this is Monte Carlo projections forward. So if you were doing that and you kept quarterly, then the 50 percentile on the Monte Carlo would carry you up to about 2 million 10 years from now. And of course, there's a very broad range.
So for future gains, are you using power law expected performance, or what's the assumption for future?
No, I just asked Chat GPT to do a Monte Carlo. So it just took
Okay.
the historical and did its own Monte Carlo. You could do that. You could do a power law and use the Monte Carlo for the noise, right? And I played with that a little bit, but I haven't fully created the results on that.
It's done a great job. I mean, the chart looks good. Or didn't give you the chart, right? I guess you.
Oh, it gave me the
give you.
chart.
Oh, okay.
I can't have to do such things. And then this one is for annual rebalancing. And this is nicer in terms of your Bitcoin holdings in the upper left. You start out with 19 Bitcoin. And in this case, it's $10,000 at the start of 2015. And today you would still have 16 Bitcoin. So that's nice. And you can see the table and it shows your equity value and your Bitcoin holdings by year, and it shows your cash balance by year. And then the chart shows the growth in the value of your equity, including the cash, and then the value of your cash alone. So you grow your equity to, basically you grow your Bitcoin holdings to 1 million, you grow your cash to 200,000. So your equity is 1.2 million by now, starting from 10,000.
How does it compare to just holding 100% and never selling?
Well, if you held 100%, you'd have 19 Bitcoin
Ah,
at
okay.
58,000. So you'd have a little more money, right?
So I want to be clear. Yeah. So here we are not optimizing the maximum performance, right? We are not trying to just optimize ownership. Well, of course, if we have 100% certainty that everything that happened will exactly happen in future, you should be 100%, or even more. You should even lever
With the
up.
benefit of hindsight, we would have always been long 200%, right?
Exactly. 1,000%. But if it's 100% likely, then there's no reason to consider any safety or any kind of margin of error. But here we are assuming that we are kind of losing a little bit of the maximum performance, but then we're adding a lot of safety and a lot of protection against adverse scenarios.
Let me correct myself and correct that. If I take 19 Bitcoin today at 58,000, that's 1.1 billion. So if all we had done is buy Bitcoin, well, okay, we've left out the year from 20. There's a problem here, which is in 2015, the price was lower and it went up to the beginning of 2016. But still,
It might actually be that the rebalancing actually helps.
well,
because
what's
if,
happened that the
Yeah.
rebalancing helped you a little bit. So you bought in 2018 and you bought again in 2022, right? Or actually, you bought going from 2018 to 2019. So the rebalancing helped you a little bit here.
Normally, maybe not, but if your rebalancing happens to be at the right times, when perhaps Bitcoin is way overvalued or way undervalued, then in those cases, it may actually be performing a lot better than the buy and hold.
It forces you to sell near peaks and to buy near lows. But since it's annual, it's a window and you might not get close enough.
So that's why probably longer windows should work better, because you get more of those rebalancing periods falling closer to the right times. Okay.
And then we have a Monte Carlo simulation, and the 1 million on the 50 percentile going out just 5 years grows to about 12 million. So you grow another factor of 10. Okay. This is just showing the difference between looking back through all the annual data or just looking back 5 years at any given point. So if I'm 2020, I only take 5 years prior. And this is starting in 2016 up until now. And in this case, I think we started with $1,000 or something. So it's lower numbers, but if you use all the data, you'd have more Bitcoin than if you have the 5-year look back. And then we show the equity curve, and you would have, again, the equity would be higher at 200,000 rather than 100,000 or so, but it's less noisy. So part of this is about your comfort level, how you sleep at night, how stoic are you, right? So you can go full Kelly, you can go full look back, or you can go, let's look back 4 or 5 years. Let's do 2/3 Kelly. You can adjust. You probably don't want to go more than a full Kelly. Now I'm going to show you the continuous Kelly, and that's going to show even more aggressive posture. And here's the continuous distribution Kelly. And this looks more like the formulas you see in TradFi. It just takes the mean expected return, subtracts the risk-free rate, the T-bill rate. I've used 4%. And then it takes the variance. It does assume a normal distribution. Now we have high volatility. So for these charts, I've used log returns, which is the log plus 1/r of the return for that particular period.
It looks like Sharpe ratio optimization. Kind of reminds me of that.
It looks like a Sharpe. And, but look at what the Kelly Criterion does to you, because you're rebalancing every week. And so sometimes it tells you to go long more than 100%. Sometimes it tells you to go short by more than 100%. It's really spiky. So you don't want to do this. You're going to get whipsawed, right? Because you're always reacting to what just happened the prior week. So what we do is we smooth this. And I used a long-term smoothing. I used a 1 epic 208-week moving average to smooth that. And with that, the optimal Kelly fraction starts out really high, 1,000%, 800 to 1,000%. And then it drops over time to now it's 209%. currently.
So when it's above 100, it means levering up.
Levering up. I personally don't recommend that. I may
Me
do a
neither.
little levering. I may do a little levering myself by buying master or buying calls, but this is stuff I do around the margins, not around core holdings.
So essentially what this does is it looks at the assets, it sees how strongly it's going up, and it reaches the conclusion that, hey, the risk is worth it to be all in, and even more than all in.
Right.
But at the same time, this is relying on past data or historical data, right?
This is completely relying on past data. Now we could plug in the expectation value from the power law, and we could say that's 42% and subtract 4% for risk-free. And we would divide 38%, but we've got to convert those to the log forms.
I would summarize this like if you went back, if you had the luxury of going back in time, then with the performance we've seen so far, it has been optimal to have some kind of leverage, right? Of course, leverage is also the reason a lot of people lose a lot of money fast, right? So it's very risky, but done right, perhaps when you solve the math, it recommends take risk. But at the same time, I love this quote from Morgan Housel in Psychology of Money. He says, the most important part of any plan is planning for the plan, not going according to the plan. So even whatever your math says, I would say like just keep it in one bucket. And then there's a whole other bucket that says everything else that I don't know, everything else that might also happen. You have to be sure that you also have a great plan for that case. Right. And I've seen people actually do use Kelly Criterion, but also do some adjustments like or percentage. And they'll say, I'll only use Kelly Criterion for a portion of my wealth, not all of it, because we don't know everything about future and we are kind of relying on past data.
Okay. Then just for fun, I compared with MicroStrategy and applied Kelly. And here, MicroStrategy is a higher risk asset. Beta is greater than 1. And so the wins and losses are measured relative to its performance against Bitcoin. You're looking at the master over BTC ratio. And there, you have to start in September 2020 because that's when...
This was a very important thing you mentioned. So here now you're assuming that a bet on MicroStrategy is a bet on it outperforming Bitcoin, and a loss is it underperforming Bitcoin. So that's the bet, or that's the gamble here.
Correct. And you have these two assets and you rebalance, and you start in September 2020 because sailors started buying in August, and you use monthly data because it's only been 4 years. And so the monthly return average for master was 4.78%, and for Bitcoin 3.6%. So the beta is 1.3. And master won 22 of the months and it lost 26 of the months relative to Bitcoin. So P here is less than 50% for master. It's 46%. And but the average win size is larger than the average loss size. So the average win was 0.22. The loss was 0.12. So the ratio is 1.8. And with that, you basically are calculating 0.46 minus 0.54 divided by 1.8, and you get an optimal fraction of 16%. So if you had a 2-asset portfolio with Bitcoin and master, you'd allocate 16% to MicroStrategy.
That's very actionable, very interesting.
Yes.
I'm right now, unfortunately, at 0% MicroStrategy. So I'm now under allocated based on this. Very cool. I like this.
Yeah. And you could also apply this against the dollar. And in a monthly time frame, it would be 29% master versus the dollar. And the expectation value is 7% per month. So for people who are afraid of Bitcoin, but just want to buy a stock, and that would include somebody like, oh, I don't know, the Swiss National Bank. Yeah, they bought MicroStrategy. Right? because the Bank for International Settlements doesn't like it when central banks buy Bitcoin. So the Swiss decide, well, I'll just buy some MicroStrategy.
It's a TradFi play on the future.
Right. And of course, other people want to buy options on MicroStrategy. And then you can do this against gold. And I have an article, Substack article on this. And with annual rebalancing between Bitcoin and gold, you want to be 77% Bitcoin. So 3/4 Bitcoin, 1/4 gold. Gold is your hedge against Bitcoin.
Very interesting.
Again, annual rebalance. And why not Nvidia? I've got another article on Nvidia in Substack, which is a better digital asset, Nvidia or Bitcoin? Well, Nvidia has been fantastic. It's been growing for the past decade at a 69% compound annual rate, exponential, right? Not a power law. And in this article, I discuss the fact that it cannot do that in the next decade, because if it did, its market cap would be 500 trillion. And that's equal to all the private wealth in the world and half of the total global wealth. That can't happen. We can't all end up in Nvidia stock. But what happens if you apply the Kelly criteria against two assets, Bitcoin and Nvidia, annual rebalancing since 2011, Bitcoin wins. And it's 66% into Bitcoin, 34% into Nvidia, basically a 2/3, 1/3. And the reason
Very
is that,
interesting.
here's what's interesting is that Bitcoin won 2/3 of the time. And when it did win, it had a much bigger ratio, factor of 10.
I had a tweet about this a few months back, which the media picked up as well. And one of my points was that, yeah, what we've seen in Nvidia is potentially a one-time thing, or even if it continues to go on, it's not going to be as strong as what we've seen, like you said. But also, it's not difficult to copy AI. There's going to be more and more, and there's going to be really strong companies that focus on the hardware, the software. They don't have much of a moat, as Warren Buffett would say. Some of the moat exists in their software, and then how the software works with hardware and the packaging and the first mover advantage and all of that. But because this technology is so transformative, every government in the world, every chip maker in the world is going to try to take a piece of this AI world. So it's really difficult to assume that a company is going to keep being the winner, right? With so many competitors. But with something like Bitcoin, because it's the protocol, it's a protocol for value transfer, it's actually not difficult to assume that it's going to win it all, because everything else that wants to do something in this space, for them, it would be much easier to build on Bitcoin rather than trying to replicate it. So AI is great, but you can't really bet on one company. That's the logic.
AI is a driver for Nvidia. Their customers are AI companies. Their 6 largest customers are the AI companies. Well, actually, it's Google and Microsoft and Apple. Sorry, it's Google, Microsoft, Meta. Who am I
Tesla?
forgetting? Tesla's not one of their largest. But basically, the AI companies and the system companies are their largest. So you take their 6 largest companies, customers, it's more than half of their revenue. So they are clearly the ones who are benefiting so much from AI. They're the platform, they're the picks and shovels. But you're right, AMD's coming for the GPU market. Intel's going to be coming for it, Samsung, the Chinese, everybody. And they will be chipping away. They will be chipping away. The software libraries that NVIDIA has are somewhat of a moat. But, you know, that can be managed as well by competitors. So it's a great company. I've got friends there. They're doing fantastic. But it cannot grow at 69% every year for the next decade. And so I think Bitcoin is going to be a better bet. And you ought to have more Bitcoin than you have Nvidia stock. Okay, this is a conventional TradFi. This is Sharp. And I got this from the Portfolio Visualizer site. It starts at the beginning of 2015 and it ran through mid-year. And I just a 2-asset portfolio with Shy, and it said 100% Bitcoin. So rather than short-term treasury bonds, you should go fully into Bitcoin. So that was interesting with Sharp, right? And it looks somewhat similar to the continuous Kelly. And you can see the little circular pie chart there. Bitcoin, 100% allocation against SHY ETF. But if you ask it about the stock market and apply the Sharp maximization, and here I use the Vanguard Total Stock Market ETF, VTI, it says 1/3 Bitcoin, 2/3 stock market. So that's what TradFi is telling you using Sharp. They had a Kelly tool at this site, but I can't find it anymore. I think they took it off. When I was using the Kelly tool on their site, it was basically giving very large allocations. It was giving the same sort of answers that we've just covered. And it was using the continuous formula. So it was saying 100%. Okay, I think this is my last slide. This is Monte Carlo retirement analysis. And I said, well, I don't know. I don't believe this 1/3 Bitcoin and 2/3 Vanguard stock market. Let's invert that. So I set up a portfolio with 70% Bitcoin and 30% Vanguard and annual rebalance. And I also had the worst year happen first. And you're basically getting something like a 30% return on Bitcoin if you use the power law. More earlier on, less later on, but roughly that over this sort of long term. And volatility, I suggested 20%. So I'm just plugging in kind of crude values here. But if you start with $1 million, you could withdraw 45,000. You could adjust for inflation using historical inflation metrics. And essentially all of your portfolios would survive 30 years of withdrawal. So that was just for fun. So summary, I think 60/40 is dead. And I think Bitcoin replaces bonds and more. You want to use long time frames with Kelly. You want to be stoic, as you say, and this leads you to higher allocations and higher returns. If you're nervous, you can cut back to 2/3 Kelly or half Kelly, and you'll still be in 50% or 40% of your portfolio. Use the Gambler's Kelly formula for intermediate to longer time frames with quarterly or annual snapshots and rebalancing. If you look at the continuous Kelly with shorter time frames and then you average it because it's so noisy, that can yield very high allocations where you're over 100% long. But for now, you would say 75% versus 25% cash with annual rebalancing with the gamblers. Against MicroStrategy, you'd be 5/6 Bitcoin, 1/6 MicroStrategy. Against gold, you'd be 77% Bitcoin. Against Nvidia, you'd be 66% Bitcoin. Sharp is more conservative, and it would put you 1/3 into Bitcoin and 2/3 into stocks. And Bitcoin's great for long-term retirement purposes.
That's crazy. That's because people think of this as, at least people, no coiners think of Bitcoin as one of the riskiest thing if you want to think about retirement. But no, it's actually one of the safest, even though it has volatility. But
yeah. Okay, so we thank Claude Shannon and John Kelly and also this Edward O. Thorpe, who did a lot of work.
very good, very good. Thank you. We should also mention that the information we provide here is for educational purposes. Definitely do your own research. We do our best to bring useful information, actionable information from the smartest people that we know. And we really appreciate your attention.
Thanks so much, Sina. It was a pleasure being here today.